When it comes to investing, we all know one thing. Equity gives the highest returns in the long run. But for the past 6 months, the market hasn't really been kind. From October till now, the market has seen a noticeable dip. Nifty 50, the large cap index, is down by 17%. Nifty mid cap 150 has fallen by 23%. And Nifty small cap 250 is down by 29%. So if someone had started their SIP during this period, their portfolio would probably be in the red right now. And naturally, many might have stopped their SIPs by thinking maybe it was a mistake to start investing when the market was at an all-time high. And now, with the market looking weak, many of them feel if I had known this fall was coming, I would have waited and started my SIPs now at lower levels to make better returns. But here's the real question. Is there a strategy to predict market peaks and bottoms? And if yes, how much extra can you actually gain by investing exactly at the bottom? That's exactly what we are going to uncover in this video. Also, there's a bonus waiting for you at the end of the video, so make sure you stick around. So the feast is ready, it's time to serve. Before we get into the strategy of predicting the market peaks and bottoms, let's first address a basic question. How much additional returns can we really get if we start investing exactly at the market bottom instead of the market peak? To find that out, I looked at the historical data of the Nifty Smallcap 250 index over the last 20 years. And why this index? Because among equity categories, small caps usually have the potential to give high returns than mid caps and large caps. That's why investors who aim for faster growth often choose small cap funds. So if we test this idea on a high risk index like small cap, then it should also apply fairly well to other less volatile indices too. While going through the data, I noticed that there were several market cycles where the market fell more than 15% from its peak. Out of those, I picked 8 major market cycles to study. Now let's say a lucky investor who was able to perfectly predict the exact market bottom in each of those cycles starts a monthly SIP of 10,000 right at that bottom and continues until March 2025. And on the other hand, there is an unlucky investor who couldn't predict the market at all, and just by bad luck, he started the same 10,000 monthly SIP exactly at the market peak before the fall. Let's see what happened to both of them. These are the 8 market cycles I have taken for this analysis. If you closely observe, each of these cycles represent a sharp correction in the market. Some lasted for months and some were quick but deep. Let's go through them one by one. Cycle 1 is from September 2005 to October 2005. In this cycle, the market fell by 18% from its peak. Then cycle 2 is from May 2006 to June 2006. In just about a month, the index dropped by 38%. Then cycle 3 is from Feb 2007 to March 2007. This time, the correction was around 17%. Then cycle 4 is from Jan 2008 to March 2009. This was the big one, the global financial crisis. The index crashed by a massive 76%. Then cycle 5 is from August 2015 to Feb 2016. This fall was around 23%. Then cycle 6 is from October 2016 to November 2016, a relatively shorter fall, but still a drop of 16%. This was around the time of demonetization. Then cycle 7 is from Jan 2018 to March 2020. This cycle covers both ILFS crisis and the COVID crash. Together, the market fell by a brutal 60%. And finally, cycle 8 is from Jan 2022 to June 2022. In this phase, the market corrected by 25%. This is due to inflation and interest rate hikes in the US and Russia-Ukraine war. So as you can see, market falls are not new. They have happened before and they will happen again. Now let's see something really interesting. What if an unlucky investor started their SIP in Nifty Smallcap 250 index right at the market peak and a lucky investor started after the market bottoms out? Who do you think ends up with better returns? Let's find out. In cycle 1, the market peaked in September 2005 and then fell by 18%. An unlucky investor who started a SIP of 10,000 per month in Nifty Smallcap 250 index right at the peak and continued till March 2025 would have earned a return of 14.7% XIRR. On the other hand, The lucky investor who perfectly timed the market, waited for the crash, and started their SIP in October 2005 would have earned a return of 14.8% XIRR. Just a 0.1% difference. Despite starting at the worst time, the unlucky investors still came out almost equal. Cycle 2 happened between May 2006 and June 2006. When the market fell sharply by 38%, you would expect a huge difference, right? But here's the twist. Both the unlucky investor who started at the peak and the lucky investor who started at the bottom earned the exact same return of 14.8%. Market timing made absolutely no difference in this case. Cycle 3 was in Feb 2007 to March 2007 with the market dropping by 17%. The unlucky investor earned 15% while the lucky investor made 15.1%. That's a tiny difference of just 0.1%. Then came Cycle 4, the most dramatic one, the 2008 financial crisis. The market crashed a massive 76% between Jan 2008 and March 2009. Now you would think this is where timing would make a huge difference. But even here, the unlucky investor earned 15.6% while the lucky investor earned 15.9%. Just a 0.3% gap despite such a massive fall. Cycle 5 occurred between August 2015 and Feb 2016. The market dropped by 23%. The SIP that began for the unlucky investor earned 17.6%, while the lucky investor made 17.9%. Again, just a 0.3% edge for the one who timed it. Next was Cycle 6, a short correction of 16% from October 2016 to November 2016. Interestingly, both investors earned exactly the same return of 18.4%. Now let's move to Cycle 7. It is between Jan 2018 and March 2020, which includes the COVID crash. The market fell almost 60%. This time, the difference was a bit more noticeable. The unlucky investor made 20.3%, while the lucky investor earned 23.8%. It's a 3.5% difference here. But remember, this came after a deep and prolonged fall. Finally, in Cycle 8, we saw a 25% drop driven by global uncertainties. The unlucky investor delivered 16.1% and the lucky investor gave 16.3%. Once again, the difference was just 0.2%. But the show doesn't end here. There is a surprise waiting for you. So far, we have seen how the XIRR looks for both lucky and unlucky investors. But what if I told you the current value of your investment might shock you even more? Let's start with Cycle 1. An unlucky investor started his monthly SIP of 10,000 in September 2005 and stayed consistent for 19.5 years with investing a total of 23.4 lakhs. Now guess what his investment grew to? A massive 1.18 crore with a 14.7% XIRR. Now let's look at the lucky investor. He waited for the crash to settle and started his SIP in October 2005. Over 19.4 years, he invested 23.3 lakhs and ended up with 1.17 crore at a 14.8% XIRR. So the one who started before the fall actually made more money than the one who waited and timed the market perfectly. In Cycle 2, the unlucky investor started his SIP of 10,000 in May 2006. Over 18.8 years, he invested 22.6 lakhs and ended up with 1.09 crore. Now the lucky investor waited till after the market crash. He started in June 2006 and he invested 22.5 lakhs and ended up with 1.08 crore. Again, the one who started before the crash actually made more money. That's the power of consistent investing. In Cycle 3, the unlucky investor who began right at the peak turned 21.7 lakhs into 99.7 lakhs. The lucky one, starting a month later, ended up with 98.9 lakhs from 21.6 lakhs. Again, the one with the worst timing actually ended up more. So SIP doesn't care about your entry point. It rewards your consistency. In Cycle 4, the unlucky investor who started just before the fall invested 20.7 lakhs and walked away with 91.5 lakhs. And the lucky investor who timed it perfectly at the bottom invested 19.2 lakhs and ended up with 78.3 lakhs. That's a massive 13.2 lakh difference in favor of the one who started at the peak. So even if you miss the bottom completely, you can still win big. In Cycle 5, the unlucky investor made a total investment of 11.6 lakhs and got back 27.4 lakhs. And the lucky investor put 10.9 lakhs and got 25.2 lakhs. Again, a clear 2.2 lakh edge for the one who started before the fall. In cycle 6, market dipped 16%, but the unlucky investor's 10.1 lakhs turned into 22.4 lakhs. But the lucky investor got only 22 lakhs from 10 lakhs. Same story. He got 40,000 extra just for showing up early. In cycle 7, the unlucky investor stayed strong and turned 8.6 lakhs into 20.3 lakhs. But the lucky one who waited until the bottom turned 6 lakhs into 10.7 lakhs. That's a 9.6 lakh lead for the person who started right before one of the biggest crashes in history. Finally, in cycle 8, the unlucky investor's 3.8 lakhs grew to 4.9 lakhs, but the lucky investor's 3.3 lakhs became 4.1 lakhs. Even in just a short cycle, that's an 80,000 difference by simply staying invested through the storm. It is interesting to note that SIPs that started at the bottom of a market cycle show slightly better percentage returns, but in actual rupee terms, it's often the SIPs that began at the peak created more wealth. Sounds surprising, right? But the reason behind this is something called the cost of delay. Let me explain that in simple words. When you delay your SIP by even a few months hoping for a better entry, you are not just missing out on returns. You are missing out on the power of compounding on that missed amount. So even if the market falls later and you start at a better level, you have already lost precious time. And over a long period, that small delay can turn into a big gap in wealth. And the longer it takes for the market to hit the bottom, the higher your cost of delay becomes. So in many cases, someone who started SIP at the worst possible time, like at the peak, still ends up wealthier than someone who waited and tried to time it right. Finally, to wrap it up, if we hadn't seen all this data, most of us would naturally assume this. The investor who starts at the bottom of the market should obviously make much higher returns than the one who began at the peak. It sounds logical, right? But the numbers say something else. Even the so-called unlucky investor who started SIPs right at the market peak still ended up building great wealth. So it is impossible to predict exact market peaks and bottoms consistently. But if you are a genuine long-term SIP investor, you don't need to worry about market peaks and bottoms when starting your SIP journey. Because when it comes to investing, time in the market matters more than timing the market. Now comes the bonus. We just saw that even if you start investing at the market peak, you can still build significant wealth over time. But let's be honest. When the market starts falling right after you begin your SIP, it can make you feel scary. And that's exactly why I had made a separate video explaining a simple yet powerful strategy that helps you earn the same kind of returns but with much less stress and lower risk. If you haven't watched it yet, make sure you do. It could change the way you invest and make your investment journey a lot smoother. And that's all for this video. But wait, one thing is crystal clear now. Staying invested for the long term can help you build huge wealth. But now comes the big question. How long is the long term mean? Is it 5 years, 10 years, or even more? And more importantly, is there any data that tells us how much time it really takes? And that's the lead for my next video, so stay tuned. Until then, this is Sabarish signing off.